A very good morning to all of you students. My name is C. Divis Gupta, and today we will be discussing about the topic of mergers and acquisitions. So students will be discussing about some of the concepts and some of the specifics in mergers and acquisitions, and then we will also go through some of the practical problems that have been shared in the assignment earlier. Good morning, Sanjay. So, mergers and acquisition students, let's first try to understand that what are the different forms of a mergers and acquisition. Because for us to understand what to be done in merger and acquisition, we need to first understand that what is meant by mergers and acquisition. So, students, mergers and acquisitions can take different forms and it can take different legal forms. So, the first one is, let's say there are two different companies called A and B. So the B company merges into A. This is the most common form of a merger and acquisition. So the B company merges into A. That means what? The business of B gets into A. All the assets and liabilities of B gets into A. The employees also gets transferred from B to A. So everything that B have gets transferred to A. Even some of the pending litigations at B's end, whether it is for indirect tax, whether it is for direct tax, or for any other commercial or civil litigation, even those will also get transferred to A. Why? Because B is getting dissolved. So B will lose its identity, its own legal identity, and it will get dissolved into A. So what this will mean that now B is not having its own identity, only A's identity will be there. Now A will be continuing with its own business as well as the business of B students. Clear? So only A will remain as A. And A will carry business of A plus B put together. Clear? So A will carry the business of A plus B put together. So this is the first form of a merger and acquisition. Clear, students? Let's discuss about the second form of mergers and acquisition. In the second form, let's again take an example of A and B being two different companies. A acquires majority stake in B Limited. In B Limited. Okay. And A is having as a holding company and B will become its subsidiary company, correct? So all of us know once the majority shares are taken over by any company, by majority we mean more than 51%, right? At least 51% shares are held by the other company, then that other company is called as the holding company, and the shares of whom which are held is called as the subsidiary company. Both of them will continue with their own legal identity. So students, please note here there is no dissolution of any company that has happened. So both of them will continue with their respective legal entity status, students. Clear? So this is the second form of mergers and acquisition. So as the name suggests, merger and acquisition. So acquisition is also one of the forms. So the second form that we have discussed is acquisition, where we are acquiring majority stake in the other company. Now third part, students. In third part, let's say there is a company called A and it has actually two businesses, business 1 and business 2. So the first business is the business of textile, and the second business is the business of, let's say, perfume. Okay. So entity A is having two businesses, business 1 and business 2, students. Now what happens? So A is actually now planning to form two different companies. One will remain with A and second will be transformed to B. So what will happen? A will retain, let's say, B1 business, and B will have the B2 business, right? Which was the perfume business, and here it was the textile business. Now you see single company now has split up into two different companies. So business 2 will be transferred from A Limited to B Limited. So this is called as demerger, students, in which we are demerging one of the business segments to another company. Clear? So this is called as demerger. It is also one of the form of mergers and acquisition. Fourth form. The fourth different form can be, let's say there is a company called A and there is a company called B. So both of them actually gets merged into a new company called C. So it will also transfer its business. And B will also transfer its business. So this will also be dissolved. And B will also be dissolved. Clear? And both of them will lead to merger. Okay. So students, if you see, this is called as merger. The situation 1 is a clear case of merger. Situation 2 is a clear case of acquisition. Situation 3 is a case of demerger. Right, where you are demerging. And situation 4 is again a case of merger. Now let's see, there can be one more situation, students, wherein, let's say, there are two companies, A and B. A is in the business of, let's say, perfumes. And B is actually having two businesses, B1 and B2. Now B1 is for the deodorants and B2 is, let's say, for the soaps. Now what will happen between A and B? Both of them will continue their legal identity. So A will just purchase the deodorants business from B. So A will pay the purchase consideration to B, and B will transfer the deodorants business to A. So B will transfer the deodorants business to A. So both of them will continue, both A and B will continue with their separate legal identity. Okay, no need for any dissolution that will happen. But now A will retain what all businesses? Perfume business and deodorant business. B will continue with only the soaps business. So this purchase consideration terminology is used to denote that for purchasing a business, you will end up paying any consideration, right? For purchasing the company in the first step, you will end up paying the consideration, right? So this situation is called as the business transfer arrangements, right? So because in this you're only transferring the business, that's all. You're not transferring the company as a whole. Okay, students? Perfect. Then let's take our discussion ahead. So these were the different forms of the mergers and acquisition. Okay. Now let's take our discussion ahead. Now let's assume that there are two companies in all our discussion going ahead, A Limited and B Limited. So A Limited is the acquiring company, which is actually acquiring another company, right? So this is called as the acquiring company, and B Limited is, let's say, the target company. So between A and B, B merges with A, right? So the first situation that we have spoken about. So in this case, B is getting merged into A. Okay. Now let's talk about the purchase consideration. As we know that students, that if the business, or let's say if the company is getting merged, it will not get merged into free, right? You will have to compensate the shareholders of B Limited because they are actually willing to give up their company and get it merged with A. So they need to be compensated for the shares that they are holding. Now it will happen through purchase considerations, but there are again different forms of a purchase consideration. The first form can be equity shares of A Limited issued to shareholders of B Limited. Please note this point, students. You are issuing the equity shares of A Limited, right, which is the acquiring company, to the shareholders of B Limited, because ultimately they need to be compensated. You cannot issue the shares to the B Limited itself because B Limited is getting merged. So you need to compensate the shareholders of B Limited, students. Okay. So you can pay your purchase consideration by way of issuing equity shares of A Limited. Okay. The second way to pay it through cash payment, By cash payment, we don't mean the real hard money cash, but let's say a wire transfer through NEFT, RTGS, through check mode. So all these things you can pay. So that means outflow of funds. So through actual outflow of funds you can pay. Again, to whom? To shareholders of B Limited. Okay. And the third one is actually a combination of 1 and 2 students. So the third one is the combination of 1 and 2. Now here the question comes that what is the right swap ratio? By swap ratio means that how many shares of A Limited in exchange of how many shares of B Limited. Correct? Because you cannot say that I will issue 1 share of A Limited in consideration of 1 share of B Limited to the shareholders of B Limited. Right? Because their values are different. Their relative positioning is different into the market. So it has to go. So it has to go in such a way that the right swap ratio is determined. Now, how we will be determining that? We will discuss that. Now, in this case, what is the question here? The question is, what is the value of payment? Right? In case you have decided to outrightly purchase the business, what is the right value of the payment? And in the third case, both value plus swap ratio will have to be determined to take the deal ahead. Okay. And all these things will borrow some of the concepts from business valuation principles. Okay. So business valuation principles will determine what is the right value of the company which will be discharged through the mode of payment, what is the right swap ratio, and what is the combination of both of them. Okay. So in a nutshell, students, what we will be doing here. So these are some 4 steps around which our entire discussion will revolve. So the first one is estimate A Limited's equity value. Second, estimate B Limited's equity value. Third, calculate swap ratio. Then post-merger analysis. Clear? So first we'll have to estimate the A Limited's equity value, then B Limited's equity value. That means the purchasing company's value, the selling company's value. Then the swap ratio. What is the swap ratio? We'll tell you how to calculate that. And the fourth part can be to do a post-merger analysis, because after merger, how the different KPIs have been with regard to that. Okay. So students, here in all the places, again I'm reiterating, A Limited is the acquiring company and B Limited is actually the target company which is being purchased. Okay. So let's start with some of the common concepts. P ratio, students, I'm just revising these concepts so that we'll just quickly jump to the questions then. So P ratio is what, students? Price by earnings, right? Or we can also say market price per share divided by the earnings per share. So P ratio is actually the multiple at which your share actually trades in the market. Multiple of what? Multiple of your earnings. If it is 7 times, that means if you earn 1 rupee, your market price will be 7 rupees. Okay, so the P ratio is that multiple. Now, students, how to calculate swap ratio? Okay. Now, swap ratio can be basis different parameters. The question will almost specify that using which parameter you have to calculate the swap ratio. So, we'll have to do that. The first one, basis market price, it will be market price per share of B Limited divided by market price per share of A Limited. Whatever that value comes out to be, that becomes your swap ratio. This is market price based. So market price based, what you'll have to do? The target company in the numerator, acquiring company in the denominator, and you have to calculate the market price per share. Earnings per share, students. If the question specifies that you have to calculate the swap ratio basis earnings per share, then you will take earnings per share of B Limited, again the target company, divided by earnings per share of A Limited and calculate their swap ratios. This is earnings based, students. Clear? Then third is actually book value per share of B Limited divided by book value per share of A Limited. Again, the same logic that the target company's book value per share in the numerator, denominator. So this is called the book value per share based. Okay. Clear? So this is the book value per share method. So in all these cases, MPS, EPS, book value per share, the funda remains same. That whosoever is the target company, that will be in the numerator. The acquiring company will be in the denominator. Now, some of the question might also ask you, so all these are the favorable measures, right? MPS, EPS, BVPS, higher it is, better it is. So these are the favorable measures. Sometimes the question might ask you to calculate the swap ratio basis the unfavorable measure. What is the unfavorable measure? For example, gross NPA. So students, NPA is actually the non-performing asset for in case of a bank, right? Non-performing asset in case of a bank will mean that how much percentage of your overall debt is not performing. That means it is not paying you the interest. For A Limited divided by gross NPA percentage for B Limited. Gross NPA based. So in this case, the equation will get reversed. Okay. So the A Limited will be in the numerator and B Limited will be in the denominator. Okay. Because for a higher gross NPA, you will pay a lower amount. So this ratio will denote that. Okay. Now EPS is equal to earnings attributable to equity shareholders divided by number of equity shares. So this is called as EPS, earnings per share. Now, sometimes the question might ask you that what is EPS after merger or post merger EPS. So this is important because the question will always ask you that what is the post merger EPS. In case of shares settlement, that means if we are settling it through shares, then PAT of A, profit after tax of B, plus synergy gain divided by equity shares of A Limited. These were the existing equity shares plus equity shares of, so equity shares issued. Equity shares issued to shareholders of B Limited. So whatever this number comes out to be, this will be your EPS post merger. So what we have done, students, here, we have first of all taken their respective profits, profits of A and profits of B. Then we have added some synergy gain. So synergy gain is basically because of this mergers and acquisition, there will be a higher amount of gain to the acquiring company. For example, let's say there are some common overheads that both A and B are incurring, but going forward, B will not incur those overheads. Reason being, because now there is a common management, right? There is a common administrative staff. So you will reduce on those numbers, and hence it will give you higher savings than what both of them individually would have driven. Second, let's say the market share of A and B combined has been consolidated, and hence they have a better bargaining power in the market. So they will be able to derive better financial results through these combinations, and hence the higher amount of gain because of this is called as the synergy gain. So we will discuss in detail what other factors contribute to synergy gain. Okay, so this is happening through share settlement. Then the second one is through payment of funds. So how are you going to calculate the EPS if the payment is happening through payment of funds? Okay. So here EPS will become PAT of A plus PAT of B plus synergy gain minus because you have paid the cash out of these two entities, and hence you will have to take a opportunity cost of that cash that you would have earned. So minus cash paid multiplied by return multiplied by 1 minus tax rate. Correct? The post tax returns, whatever you would have earned on that cash, had that been invested into the business, that you will reduce. Because that much of amount you will not be able to earn in future. This whole divided by equity shares of A Limited. Okay. So clear, through in case we are paying through funds through cash outflow, then how we can calculate the EPS is through this method. Clear? Okay. Then the next part is actually how do we denote synergy. So the value of A and B combined is greater than value of A and value of B. So getting the synergy gain is one of the foremost principle for which the mergers and acquisitions are done. So this is the merged entity. This is A limited individual, B limited individual. So what are the different factors that will contribute to synergy? One, now there is a common board of director or management, right? Supervision will also be common. There will be savings in overheads, right? And in support functions. Similarly, their market power collectively have increased, right? For example, A was a supplier and B was a customer. Now both of them collectively are holding higher amount of value chain. So that value chain of higher amount will help them in driving better results, right? So these are the factors which will lead to benefits in the form of synergy. Okay. Now, sometimes the question might ask you that what is the effect on EPS post merger? So students, above we have calculated that what is the EPS post merger, but here we are trying to calculate what is the effect on EPS post merger. So for acquiring company, which is let's say A Limited, post merger EPS less pre-merger EPS, net impact on A Limited will be this only, right? It's just a direct comparison between what is the post-merger EPS and pre-merger EPS. Okay. Then for the other company, which is B Limited, students, here it will be post-merger EPS of A Limited. Why A Limited? Because B Limited has been dissolved now, right? So we'll take the post-merger EPS of A Limited and we will reduce the merger EPS of B Limited. Now, this is going to tell us the net impact on target company's EPS. But there is one mistake that I did here, and I've deliberately done that. In case anyone of you would want to contribute to what could have been the correction here. So we are seeing for B Limited students, we will take post-merger EPS of A Limited and compare it with the pre-merger EPS of B Limited. Is this comparison right or there is some adjustment required here, students? Please do remember one share of post-merger. Yes, go ahead.
This is post-merger EPS of B Limited should be taken.
No, but there is no B Limited now. The B Limited has been dissolved. The only post-merger entity remaining is only A Limited. But I think what you're saying is correct to some extent, we'll have to take the equivalent value from this A limited for B limited. That means we will have to adjust for swap ratio here. Adjusted for swap ratio. So you will have to adjust swap ratio in this value. Reason being, see, if you don't adjust, then you will assume that one share pre-merger of B limited is as good as one share post-merger of A limited. Right? In this case, what we are assuming, the ratio is 1:1. One share of B limited is equal to one share of limited. But that's not the reality. The reality is the B limited and A limited are both of them related through swap ratio, right? And hence we will have to adjust for the swap ratio, students. Clear? So one share of A limited post merger is not equal to one share of B limited pre-merger. Correct? So hence we will have to make them equalized and hence we'll have to adjust for the swap ratio. Okay. In case of A limited, why this question never arised? Because the post-merger one share of A limited is as good as one share pre-merger of A limited. So pre and post 1:1 ratio holds true for A limited, but not for B limited, which is getting acquired because there is a swap ratio there. Okay. Now, students, sometimes the question might ask you to calculate the value of acquisition. So this, sorry, coming back to this, I will, so basically you will all will be able to understand it better once we do some question also. Okay. Then we will be able to understand it better. So this is happening from whom? A Limited's perspective. So from A Limited's perspective, what is the value of acquisition? That means from the acquiring company's perspective. So value of the merged entity minus value of acquiring company before merger, which is actually A Limited before merger. So that means, let's say before merger, the value was 100 crore and after merger, the combined value became 120 crore. So the value of acquisition is actually 20 crore. Okay. Sometimes the question will also ask you to calculate the gain loss to shareholders. Okay. So there is a gain loss to the shareholders that is involved. How come? From A Limited's perspective, the market price per share of post-merger A Limited minus market price per share of pre-merger A Limited. Simple. Because here also the ratio is 1:1. Correct? So you can do post-merger and pre-merger. Simple comparison, students. Okay? Then the next part is actually a bit tricky for B Limited. How do you calculate the gain or loss to the shareholders of B Limited? By just comparing market price per share of post merger B Limited less market price per share of pre-merger. Wait, this should not be B Limited but A Limited minus market price of pre-merger B Limited. Now here again there is one impact that we will have to adjust. So this should be adjusted for swap ratio. And reason being clear, because swap ratio is the common linkage between pre-merger B Limited 1 share and post-merger A Limited 1 share. Right? So that needs to be adjusted. So this will give us the gain slash loss. Clear? Okay. So just like effect on EPS, the gain or loss to the shareholders can also be computed through market price per share. In case of B Limited, we will have to be watchful of what is the swap ratio, because swap ratio is going to link between both of them. Okay. Perfect. Then market capitalization is equal to market price per share multiplied by number of equity shares, that we all know, right? Clear? Then sometimes there is a concept in the question called as promoters holding. So students, please do remember, whatever is the percentage given to you, let's say 60% or X percent, that means it's a promoter driven holding. That means promoter is holding these much of shares. And if the question tells you about the free float market capitalization, this is actually determined how? Through regular market capitalization multiplied by 1 minus X percentage. So the overall market capitalization multiplied by 1 minus X means what? X is the promoter's holding. So free float market cap means other than promoter holding, what is a regular market capitalization? Okay. Then true cost of merger actually means the gain to the shareholder of B Limited. Gain to, like we have computed above, right? Gain to shareholder of B Limited, which is actually target company. Okay, this is the gain to the shareholders of B Limited is actually the true cost of merger. And sometimes the question can ask you that what is the value of merger? Is actually gain to the shareholders of A Limited, which is the acquiring company. Gain to shareholder of, which is actually the acquiring company, students. Okay, clear? Any questions or any doubt till now, students? Perfect. So let's come to question number 1, students. Okay. Uh, okay. Assignment is not available on the portal, is it? Okay. Um, okay. So let's do one thing for now. I request you to please go through the question on the screen displayed, and meanwhile, I will request uh, for getting it uploaded. Okay. Hope that is okay. Okay. So question number one, students, is actually about the Reliable Industries Limited is considering a takeover of Sunflower Industries Limited. So RIL is considering a takeover of SIL. The particulars of two companies are given below. One, 20 lakh rupees of earnings after tax for Reliable Industries and 10 lakh for Sunflower Industries. Equity shares outstanding is also given 10 lakhs and 10 lakhs. Earnings per share is rupees 2 and 1. So this is their EPS, and the PE ratio is given as 10 and 5. Required. What is the market value of each company before merger? That we can just simply calculate. How? We have the EPS, we have the PE ratio, and we have the number of shares. We can calculate the overall market value. Now, the second one, assume that the management of RIL estimates that the shareholders of SIL will accept an offer of one share of RIL for four shares of SIL. That means the swap ratio is 1 is to 4, right? If there are no synergic effects, that means they are saying there are no over and above effects of the benefits to the P&L. What is the market value of the post-merger RIL? What is the new price per share? Are the shareholders of RIL better or worse off than they were before the merger? So they have asked us 2-3 data points in this. And the last one, due to synergy effects, the management of RIL estimates that the earnings will increase by 20%. What are the new post-merger EP price per share? Will the shareholders be better off or worse in the merger? So the question is actually asking you to, in three different subparts, to first of all calculate the pre-value merger and then take the merger discussions ahead. Okay. So let's start, students. Let's start with the easier one, the solution. So the first part of the solution is to calculate the market value of each company before merger. So the market value of each company before merger is actually, we will just take both the figures here. EPS rupees 2 and 1. This is given in the question, students. Okay. Then PE ratio. The PE ratio is actually 10 and 5. Okay. Then market price per share is given as 20 and 5. So how we can calculate this? 10 into 2 and 5 into 1. Correct? So in a way, PE ratio multiplied by EPS, a simple calculation, right? P ratio multiplied by EPS. So this, we will calculate the market price per share, and then we have the number of equity shares, which is around 10 lakh and 10 lakh. Right? So the total market value becomes market price per share multiplied by the number of equity shares. So 20 into 10 lakh, which is 2 crores. Similarly, 5 into 10 lakhs, right? So which is 50 lakhs. Clear, students? So 2 crore and 50 lakhs becomes their market value before merger. The post-merger effect on RIL, let's discuss about it. Post-merger effect on RIL. This is without synergy. without synergy. Okay. So let's talk about the post-merger earnings of both RIL and SIL. Post-merger earnings will be 20 lakhs plus 10 lakhs.
Sir, equity
Correct?
shares of Sunflower Limited is 10,000. No?
Sorry?
Equity shares.
Mm-hmm. 10 lakhs here. Okay, let me just show the question again.
Okay, sir.
It is 10 lakhs, okay?
Okay, sir.
So the post-merger earnings is actually the total earnings of both RIL and SIL, which is 2 into 10 lakh for RIL and 1 into 10 lakh for Sunflower. Right? So in totality, it is 20 lakh and 10 lakh. Right? Which is actually 30 lakhs. Okay? Then divided by number of equity shares. So already issued equity shares of RIL are 10 lakh and swap ratio for SIL is 1 by 4. So we can just mention here swap ratio is 1 share of RIL for every 4 share of SIL. Correct? So that we have adjusted here as the swap ratio. So the total number of shares are 10 lakh. Sorry, it's not multiplied, it's plus here. 10 lakh plus 2,50,000 in totality 12,50,000, right? So the total 30 lakhs of earnings will be divided by 12,50,000 number of shares. So the earnings per share actually comes out to be 2.4. Okay. How come 30 lakhs divided by 12,50,000? And hence the PE ratio using the RIL's PE ratio was 10. The market price post merger will become 10 into 2.4, which is 24 rupees. And the market value post merger will become 24 into 12,50,000. Right? So 24, which is the market price per share, multiplied by 12,50,000, it becomes 3 crores. Less pre-merger value of both RIL, SIL. This we have computed in the first step, right? RIL was how much? 2 crores. And here it was 50 lakhs. So this is from first step, right? So in totality, this comes out to be 2.5 crores. So the total gains from merger is actually 50 lakhs. right? So the total gains of merger is actually 50 lakhs. Now, if we want to apportion the gain here, there are two different ways to do that, right? One, that how much percentage of holding of SIL is represented into the post-merger amounts. That is one. That is simply 2,50,000 divided by 12,50,000 number of shares, right? And there is one more way. So I'm just taking the other way. Both ways are correct, whichever way we want to do. So the apportionment of gains to RIL and SIL, RIL, SIL, post merger market value. So students, you would recall that 10 lakh shares were of RIL, which remained with RIL, and 2,50,000 shares is what we have issued to SIL further, right? So 10 lakh into 24, 2,50,000 into 24. So this becomes 2.4 crores and this becomes 60 lakhs, right? Which is the equivalent of 3 crore. The total value is 3 crore, right? Then less pre-merger value was how much? Pre-merger value was how much, students? It was 2 crores here and 50 lakhs here. Okay. So this is actually 40 lakhs. If we compare the pre and post merger, which is 2.4 crore minus 2 crore, and here it will be 10 lakhs. So if you see, total gain of 50 lakhs is distributed as 40 and 10 lakh respectively between the SIL and RIL limited, right? Post merger. But please do remember, students, there is no separate legal entity identity for SIL remaining. Okay. Thus, the shareholders of both the company RIL plus SIL put together are better off than before. Clear? So both of them are better off than what they were before. Clear? So it is in their both the interests to do the merger, because post merger they are going to drive it better. Now what's the second part of the question? They are saying, let's say there is a synergy benefits which will increase the earnings by 20%, and then they are asking you to calculate what is the new post merger EPS according to this new facts of the information that is given to you. So let's do the step third, or let's say part third. So the post merger earnings including synergy will be 30 lakhs into 1.2, which is equal to 36 lakhs. Okay. So this is the post merger earnings. Number of equity shares will remain same, 12,50,000. The EPS will be 36 lakh divided by 12,50,000. Correct? 2.88. We can just mention here 36 lakh divided by 12,50,000 students. The PE ratio becomes 10 times. So this is already given in the question. This was already given in the question, and hence the MPS will be 2.88 into 10 times, which is actually 28.8 per share students. So in the earlier question, it was 24 rupees. In the earlier part, it was 24 rupees. Now it is 28.88. Right? So even in case of 24 rupees, the shareholders were better off. So 28.88 also the shareholders will be better off. Clear, students? Any doubt or any question till now? Please do let me know. Okay, how did we get 1.2? 1.2 is basically the 20% increase. Yes, okay. So this 1.2 is actually the 20% synergy gain. Okay, this is 20% synergy gain. So let's move to question number 2, students. C Limited and P Limited, both companies operating in the same industry, decided to merge and form a new entity, S Limited. Now you see, this is one of our case, I think fourth or fifth case, wherein now they're merging and creating a new company. The relevant financial details of the two companies prior to the merger announcement are as follows. C and P, their respective earnings, number of shares and P ratio is also given. The merger will be effected by means of a stock swap, which is the swap ratio of 3 shares of C Limited for 1 share of P Limited. Okay. So, higher number of shares of C Limited will be issued for 1 share of P Limited. After the merger, it is expected that due to synergy effects, annual earnings post-tax are expected to be 8% higher than the sum of the earnings of the two companies individually, which is fine. Further, it is expected that the P ratio of S Limited, which is the new company, shall be the average of the P ratios of the two companies before their merger, which is 8 and 10 put together. Their average will be the average of will be the P ratio of the S Limited, students. Evaluate to the extent to which shareholders of P Limited will be benefited from the per share from the proposed merger. So that means they're asking us to calculate from the perspective of P Limited. That we can do easily, yes. So for that, first of all, let's calculate step by step that what is their market value, earnings, and then we'll go to the post merger analysis. So the first part, what is the earnings of new company, which is S Limited? This is the new company. So their earnings will be the total of C Limited and P Limited and the synergy value. Earnings of C Limited. That is given as 10,000, right? In lakhs it is given. So let's mention here rupees in lakhs. So this is very, very important, students. Whatever denomination you are using, let's say you are using the similar denomination, so just note that, just mention that in the solution as well. Okay, so earnings of C Limited is already given as 10,000 lakhs. Earnings of P Limited is given as 5,800 lakhs. So in totality, 15,800 is what it is given. Growth at the rate of 8% because of synergy will be there. So 8% of 15,800 will be 1264, right? So the collective amount of 15,800 plus 1264 is actually 17,064 students. So this is the overall earnings of S Limited, the new company. Okay. Now the second part is actually to calculate the market value of S Limited post merger, right? S Limited is the new company. So the market value of S Limited is actually earnings of 17. So earnings by P ratio, right? Earnings is how much? 17,064 multiplied by average of both the companies as P ratio, right? 10 and 8 is their P ratio. So divide by 2. So 17,064 multiplied by 9 is equal to 153,576. This is going to be their market value of S Limited. $153,576. This is after merger. Now the number of shares in the new company will be what? Right? Because there are two different companies. So we'll have to actually calculate that how many number of shares in S Limited are there and represented by which company, C Limited and P Limited both. Number of shares in S Limited. So which is actually given as number of shares of C Limited, which are as is. How many number of shares were there? 4,000 and P Limited was 1,000. Okay. So 4,000 will remain as is. And number of shares of P Limited students. So P Limited had originally 1,000 shares. And what was the exchange ratio agreed between both of them? 3 shares of C Limited for 1 share of P Limited. Okay. So that means multiplied by 3. So 3:1 is the swap ratio. So 3 shares of C Limited for every 1 share of P Limited. Clear? So 3,000 shares will be represented by P Limited's shareholders and 4,000 shares will be represented by C Limited's shareholder. So the total number of shares is actually 7,000. Is actually 7,000. So ultimately, what is the gain to the shareholders of P Limited? of, because we have to calculate the gain to the shareholders of only P Limited, right? Hence, again, in rupees and lakhs. Okay. So the percentage of holding of shareholders of P Limited in S Limited, students. This is actually how much? 3000 divided by 7000, right? This is their percentage. Let's denote through this only. Then market value attributable to the shareholders of P Limited. Okay. To shareholders of P Limited in S Limited. That means of P Limited within S Limited, how much is the market value? 153,576. 153,576 multiplied by 3000 divided by 7000. So this becomes 65818.29. Okay, so this is the post merger value attributable to P Limited minus market value pre merger of P Limited pre merger. Okay, so this is actually how much? 5800 into 10. 10 is the P ratio, 5800 is their annual earnings. So that means 58,000 becomes the reduction from the comparison, and hence the gain to the shareholders is actually 7818.29 divided by number of original shares. That was 1000, and hence the gain per share becomes 7.82 per share. So this is their gain that has been generated because of this merger and acquisition, students. I hope the solution is clear till here, students. So one, this question has only asked us to calculate the gain or loss to the only one company, which is P Limited. In this, we have adopted an approach that how many percentage of holding is held by the shareholders of P Limited within the new company, and hence we have arrived at what is their pre and post merger value of only P Limited shareholding in S Limited, and then we have divided by the number of original shares to arrive at the gain per share. Clear? So let's move ahead, students, to the question number 3. Okay. So question number 3, students. Messrs. Tiger Limited wants to acquire Messrs. Leopard Limited. The balance sheet of Leopard Limited as on 31st of March 2012 is as follows. So the Leopard Limited is the target company. Okay. Equity share capital of 70,000 shares. Okay, there is a typo here. Please just note here it should be 7 lakh here, and hence the overall number will come. Okay, so this 7 lakh is a typo. So this 7 plus 3, 6, 13, and 6, 20 is 1620. Okay, so this is the total. And then it has cash, debtors, inventories, plant and equipment, retained earnings, debentures, and creditors. Additional information: shareholders of Leopard Limited will get 1 share in Tiger Limited for every 2 shares. So the swap ratio is 1 is to 2 students. External liabilities are expected to be settled at 5 lakh. Shares of Tiger Limited would be issued at its current price of 15 per share. Debenture holders will get 13% convertible debentures in the purchasing company for the similar amount. That means 3 lakh, instead of 12%, it will get converted to the 13% convertible debentures. Debtors and inventories are expected to realize 2 lakh. So that means collectively these will realize only 2 lakh. Tiger Limited has decided to operate the business of Leopard Limited as a separate division. So once the takeover happens within Tiger, it will operate as a separate division. The division is likely to give cash flows after tax to the extent of 5 lakh per year for 6 years. So this division will give you 5 lakh rupees per year for next 6 years. Tiger Limited had planned that after 6 years, this division would be demerged and disposed of 2 lakh. So this is a terminal value. After 6 years, the terminal value is 2 lakh, and the recurring cash flow till 6 years is 5 lakh. The company's cost of capital is 16%, that means their discount rate is 16%. Make a report to the board of directors advising them about the financial feasibility of this acquisition, and these are the net present values. So, student, this question is having two different concepts, right? Till now, whatever we have studied stands hold true, right? That is more from, let's say, at what value the swap ratio will be, what is the post merger EPS, post merger MPS. But here the question is additionally asking us to calculate the NPV of this acquisition. What is the net present value of this acquisition? How can we calculate that? We have been given the future incomes and the future terminal value, right? So if I ask you to calculate the NPV of acquisition of this company, how we will do that? We will take the present value of cash inflow. This is for 1 to 6 years, right? Plus present value of terminal value. This is on the 6th year. This is happening basis the demerger of rupees 2 lakh, right? That is given in the question, minus cash outflow that is happening today, right? Now let's first of all calculate the purchase consideration. How can we calculate the purchase consideration? We will be issuing shares, issue of shares. How much? So we will issue for 70,000 shares, 1 is to 2, right? And the market price of Tiger is how much? 15 per share,
Yes.
correct? So the overall amount that will be incurred as a purchase consideration is 15 into 70,000 into 1 by 2. This is clear, students?
Yes, sir.
Perfect. So this is the amount that will be incurred for purchasing the Leopard Limited. So this is 5,25,000. Now once you acquire this, you will have to settle the external liabilities and adjust for the realization in cash, right? So external liabilities is how much? External liabilities is given in the question, it will be settled at 5 lakh rupees. So in a way, 5,25,000 worth of shares we are issuing to Leopard Limited. 5 lakh worth of liabilities are getting settled outside. 13% convertible debentures will continue at 2 lakh, 3 lakh rupees, right? So this is how much? 5, 5, 10, 3, 13 lakh 25,000.
Sir,
This is going.
will there be any change from conversion of debentures from 12% to 13%?
No, it will not, because it's not basically an event that is as of today, right? So we will not take any incremental amount there.
Okay, sir.
Okay. Then we will reduce the realization of debtors and inventory, because while purchasing the business, I will be selling the debtors, selling the inventory and realizing the debtors at the rate of 2 lakh rupees. So this will be my cash inflow, right? Then I also have cash in the balance sheet to the extent of 50,000. This also I will reduce, right? So the net amount will become 10,75,000. So the net cash outflow slash purchase consideration will be 10,75,000. Correct? 13,25,000 minus 2,50,000. So this is going to be my net cash outflow. Simple. Then this number has to be compared with the present value of the cash inflows generated by the acquisition. So the NPV will become 5 lakh present value annuity factor at the rate of 16% for 6 years, correct? Plus on 2 lakh present value factor. So students, please do remember this is present value annuity factor. This is only present value factor. Why? Because present value annuity factor means that every year you will be getting 5 lakh rupees, and hence the cumulative amount has to be taken. But in the case of 2 lakh, which is just a present value factor for 6 years, that's all. That too for 16% and 6 years. Minus 10,75,000. So the NPV of 5 lakh multiplied by, what we will do, students, we will just add all these 6 values. 0.862 plus 0.743 plus 0.641 plus 0.552 plus 0.476 plus 0.410. Okay, so this becomes 3.112,799 and 5.
3.684.
Yes, 3.684. Perfect. Okay, so these all will get multiplied by 3.684 plus 2 lakh into the last Annuity factor is 0.410. 410 minus 10,75,000. So the NPV becomes 8,49,000. So 5 lakh into 3.864. Can you just check once the calculation?
Yes, it is 8,49,000.
Perfect. Okay. Thank you. Thank you for the confirmation. Now, I hope, you see, this is a different perspective to the entire mergers and acquisition, right? In this, the company is actually trying to analyze it from the futuristic angle, right? And what is the current situation of my assets and liabilities is, right? So since NPV of the decision is positive, it is advantageous to acquire Leopard Limited. Clear? So in this case, since NPV was required, hence our decision was basis. Had these NPV been negative, we would have said that there is no need to acquire the new company because then it will lead to your reduction in the value. Now there was one of the question, there was one of the query answered by one of the student that is there a need to adjust this 12% and 13% conversion? Okay. Now let me actually link it back to the solution that we have discussed. Now, the question was very valid. We are given today's assets and liabilities, and we have also been given next 6 years cash flows, right? So, anywhere we should adjust, right? Because this 1% extra will lead to higher interest payments, correct? But when? In future, not now. So, is it appropriate to adjust it today? The answer is no. We will not adjust it today. Correct? Because today's my assets and liabilities will stand to the value of that how much? 3 lakh rupees for debentures, right? So I have taken the same value. Now, in future, the quotient itself have given us that there will be a net realization of 5 lakh. That means this extra 1% adjustment would have been part of this 5 lakh rupees. Correct? So if you see, the division is likely to give cash flows after tax. That means extra 1% is already accounted for here. And then this 5 lakh has been arrived at. Clear? I hope the
Yes.
student who have asked this question is clear now.
Yes, sir.
Okay. So hence we have not adjusted anything for that 1% because that is a logical assumption to make. Correct? So perfect. We have covered till question number 3, students. Let's take quick break, students. We will again reconvene in another 10 to 12 minutes. Okay. Thank you. Let's start with question number 4. C and D Limited are contemplating a merger deal in which C Limited will acquire D Limited. The relevant information about the firms are given as follows. Just a second, let me check in case of any queries. No, yeah. Total earnings in millions of C Limited and D Limited is given. Number of outstanding shares S in millions. So basically they're representing number of outstanding shares in S. Earnings per share is EPS, price earnings ratio and market price per share. What is the maximum exchange ratio acceptable to the shareholders of C Limited if the P ratio of the combined firm is 7? What is the minimum exchange ratio acceptable to the shareholders of D Limited? The P ratio of the combined firm is 9. So students, it's a just simple phenomena that whosoever is purchasing will agree for the, let's say they will say that okay, this is the maximum that we can give you, not beyond that. Okay, and whosoever is selling their business, so they will expect that this is the minimum that we should get in terms of the exchange ratio, right? In terms of the swap ratio. So this is how the question is also drafted. The 7 is the P ratio and 9 is the P ratio. Now what we can do is simply we can just calculate that what is their maximum exchange ratio and minimum exchange ratio using these facts. Okay. So let's start with the solution, students. So the first part is around maximum exchange ratio. Maximum exchange ratio acceptable to shareholders of C Limited. These all calculations that we will be doing is in millions. MPS of C Limited, right? This is the company which is actually acquiring D Limited. So 38.4 per share, that is given in the question. Number of equity shares of C Limited is how much? This is also given in the question. 20 million shares are outstanding. So 20 is the number of equity shares. Market capitalization, students. Can we calculate the market capitalization? The answer is yes. It's a simple multiplication of number of shares multiplied by the MPS, which is actually correct, 20 into 38.4 per share, which is the MPS multiplied by the number of shares. So this is 768 million, students. Okay. Combined entities earnings is how much? Now we have been given combined entities PE ratio. So we'll have to arrive at the combined entities earnings as well, right? So the combined entities earnings is how much? The combined entities earnings is actually 96 plus 30. So overall we have how much? 126 million of the combined earnings, right? Combined entities earnings. Let's write it like this. Combined entities earnings is 126. Then the combined market capitalization is actually 126 multiplied by 7. 7 is the P ratio, right? P ratio is 7 times. That is given in the first part of the question. So 126 into 7 is 882. And hence, okay, let's write it again below here. Minus market cap of C Limited before merger 768. So 114 is the balance available for D Limited. Okay. So in a way, the incremental value, think it from the company which is acquiring, which is in this case is what? C Limited, right? So think it from C Limited's perspective. After merger, the overall value will be 882. Before merger, my value, let's say C Limited, my value is only 768. So how much incremental value I'm getting? 114. So to what extent I can give the purchase consideration is 114, right? So let's assume, but in this case, the purchase consideration is issued in in shares. So we'll have to calculate the number of shares. So let's assume number of shares to be issued to D Limited be D. Okay, let's assume it to be D. Revised MPS. Market price per share after issuance of shares to shareholders of D Limited is MPS post merger is equal to what is my total market capitalization? 882 post merger, right? This is 7 times PE divided by the existing number of shares plus shares issued to D Limited. Okay. And therefore, D is equal to the incremental amount of 114 divided by the new MPS of 882 divided by 20 plus D. This is one and this is the second one. So the incremental amount is only 114. So this 114 will be divided by the market price to arrive at how many shares can be issued. So this will be given by the equation that is here. So here D is equal to balance available for D divided by MPS post merger. Clear? So this is MPS post merger. Correct? So if we solve for this, then D is equal to 114 multiplied by, so this denominator will move to the numerator. So 114 into 20 plus D divided by 882. So D becomes 2.5 2.96875 million shares. So this is in combined entity, these much shares to be issued. Clear? So this will represent to D, which is the target company. Now using this, we can calculate the exchange ratio. Yes. Hence, exchange ratio is 2.96875 divided by 14. Correct? These were the original number of shares. 14. Correct? Of D Limited. So the exchange ratio is coming out to be 0.212:1. So this is the maximum exchange ratio from C Limited's perspective is 0.212:1. Clear, students? Now similarly, we will calculate the minimum exchange ratio acceptable to D Limited. And please do remember, now in such a case, the P ratio is being changed to 9 times. So the minimum exchange ratio acceptable to D Limited's shareholders is how much? In millions, if we have to write, the market price per share is 15 per share. Now these all particulars we are writing for whom? We are writing for D Limited, right? So D Limited, market price per share is 15 per share. Number of shares 14 million. Correct? Market capitalization $15 per share into 14 million. So this is 210 million. This is their market cap. Now let's calculate the combined earnings. Again 96 plus 30, 126 combined market capitalization is actually 9 times multiplied by 126. Right? Now the P ratio, revised P ratio is 9 times multiplied by 126. So it becomes 1134. Right? So less market cap of D Limited 210. So 1134 minus 210, it becomes 924. This is balance for C Limited. Correct? So if 210 is the existing market cap of D Limited, the incremental is 924, which will be available for this company, right, which is C Limited. Then we will compare the C Limited's value to arrive at the revised post-merger EPS. Okay, let it be. Let again the D, let D be the equity shares to be issued to shareholders of D Limited. So the revised MPS post-merger will be what? 1134 divided by 20 plus D. So 1134 divided by 20 plus D. So this is basically the overall value, okay, divided by 20 plus D. Hence, D is equal to 210 divided by. So this 210 is basically their own value, right? At least they will expect their own value to be reflected by the number of shares that has been issued to them, right? So what we will do? We will do 210 divided by the revised market price per share, students. So which is 1134 divided by 20 plus D. So this is what? Minimum value expected by D. Divided by the revised MPS per share. This is post merger. Okay. So the value of D here becomes 4.54545 million shares, and hence the exchange ratio is equal to 4.54545 divided by 14, which is actually 0.325:1. So you see how delimited will do the calculation. Delimited will say that, okay, at least I should be preserved in terms of my value. What will C Limited say? C Limited will say, okay, since you're getting into my valuation, I will see that what is the net increase in my valuation. Only to that extent, I will be issuing you the shares. Now, an important comparison here. C Limited's maximum exchange ratio was how much? 0.212:1. D Limited's minimum exchange ratio was how much? Minimum exchange ratio was 0.325:1. So that means what, students? The deal can never happen, right? Because C Limited will say that I will be able to pay maximum 212:1 shares, 0.212:1 shares. D Limited will say that minimum I will expect this much. So neither C Limited will increase nor D Limited will decrease beyond this. So it might create an issue, but again, they will now consider other factors, right, into this deal. And in case both of them agree to a middle point, let's say 0.3:1, I'm just assuming for a hypothetical thing, then they will be able to close the deal. Otherwise, the respective. Okay, one more thing. Here the P ratio was 9. Here the P ratio was 7. So, in case we calculate P ratio basis 7 also here, then it might have a different story. Okay, so they have taken the different P ratios as well. Clear, students? Let's come to question number 5. ICL is proposing to take over SVL with an objective to diversify. Now, there are different objectives, students. One of the objective is to diversify. Diversification of what? Diversification of risk. You would have studied in the portfolio management. ICL's profit after tax has grown at the rate of 18% per annum, and SVL's PAT has grown 15% per annum. So 18 and 15. Both the companies pay dividend regularly. The summarized profit and loss account of both the companies are as follows: ICL and SVL, net sales, PBT, interest, provision for tax, PAT, and dividends. Similarly, for SVL, they have given us these piece of information. They've also given us the balance sheet below: fixed assets, land and building, plant machinery, furniture, current, less current liabilities. They have creditors, OD, provision, and provision for dividends and net assets. Paid up share capital is this much, reserves and surplus, borrowings, and capital employed. Okay, and the market price per share is also given as 52 and 75. ICL's land and building are stated at current prices. SVL's land and building are revalued 3 years ago. There has been an increase of 30% per year in the value of land and building. Okay, so the land and buildings have been increased by 30% per year 3 years before. SVL is expected to grow at the rate of 18% each year after demerger. Okay, so they are saying if they, sorry, each year after merger, not demerger, after merger. So if SVL is getting merged, then instead of 15%, it will grow at the rate of 18%. ICL's management wants to determine the premium on the shares over the current market price, which can be paid on the acquisition of SVL. So they are trying to understand that at what premium we can actually over the current market price. What is the current market price? They have given us as 75, right? Over and above 75, what we can offer to them. You are required to determine the premium using net worth adjusted for the current value of land and building plus the estimated average profit after tax for the next 5 years. The second is dividend growth formula. The third is ICL will push forward which method during the course of negotiation. That we will be able to understand it better. So let's first of all start with the premium calculation. Calculation of premium means what extra you will pay over and above the market price. The market price is already given to us, right? So that will depend that how much value are we getting. See, ultimately, okay, if I may ask you that the real value of land is, let's say, 1 crore. Okay, let me twist the facts to like this. Let's say the market value of land is 50 lakhs. Okay, this is the market value stated. But once you purchase this land, for you, the perceived benefit of this land will be at least 1 crore because you already have an adjacent land to it. I'm just hypothetically saying you already have an adjacent land to it. So if you combine both of these land parcels, you will be able to negotiate better. You will have, let's say, better economies of scale operating into that zone, and you will have a collectively higher power. Hence, the higher market value of land perceived for you is 1 crore, although you will end up paying only 50 lakhs. So, while purchasing the land, you can offer up to 1 crore for that land, correct? Because you will be getting extra benefit of 50 lakh rupees, students. That is what the premium is. Premium of 50 lakhs, which is 1 crore minus 50 lakhs, is getting generated because you can actually generate higher returns on this land. So this is what this question is all about. We will have to see that what is the perceived benefit because of the purchase of this land and what is the real cost of the land, students. Okay. So computation of premium in terms of rupees crore. So the total assets are how much? 550 So this we are talking about 550 here and 580 here. Okay. So furnitures and fixtures and current assets. From that, we will reduce the total of liabilities as well, which is this much 240. Okay. So let's compute first what is the total assets 550 plus 580. This we are talking about SVL less liabilities. So this 105 is the external liability of borrowing as well. Okay. So 240 plus 105. This becomes 345 and here it was 1130. Right. So this becomes the 785 of net worth. Okay. So since land was revalued, right, 30% per year for 3 years, so the current revalued land and building, what is the value? 190 is their book value, right? Into 2.197 is 417.43 less book value of land and building is actually 190. So the incremental benefit because of the revaluation is 227.43. So this 2.197 students we have arrived at for 3 years future value factor at the rate of 30% for T. Okay. So 227.43 students, this is actually the net increase due to land and buildings, right? So the adjusted net worth will be an increase to the existing net worth, which is 785 plus 227.43. This is what the increase is. which is 1012.43. Correct? Then we will also see what is in next 5 years we are getting. So the current profits after tax at the rate 15% for 5 years. So 250, which is their current profit, right? That will grow at the rate of 15% per annum for next 5 years. So we will use what? Future value 15% for next 5 years, which is 7.7537. So 250 multiplied by 7.7537, 1938.43. Correct? So from this, the average profit of 1 year will be how much? Divide by 5. So this means that over a period of 5 years, you will be able to accumulate this much. So average profit for 1 year will be 1938.43 divided by 5, which is actually 387.69. So the total value of the firm will be how much? So if you see what is net worth adjusted for the current value of land and buildings plus the estimated average profit after tax for the next 5 years. You see the interpretation of this now? Correct? So we have first of all taken the book value net worth. In that we have added the revaluation of land and buildings plus average of the estimated profit after tax for the next 5 years also we have taken. So the total value of the firm becomes 1012.43 plus 387.69, 1400.12. So the total market value will be 12.5 multiplied by 75, right? So how have we arrived at this? $12.5 is their number of shares and 75 is their market price per share. Okay, so these are number of shares and this is market price per share. Clear, student? So 12.5 into 75 is the total market value, which is 937.50. If we reduce this, then it becomes 462.62. This is the premium that we are talking about, right? Over and above the current market value, how much you are able to give is this much. So the percentage premium is 462.62 divided by 937.50 into 100 is equal to 49.35%. Okay, so this was the first part, students. Similarly, we have the second part of basis dividend growth model. So dividend growth model states that the market price per share is equal to dividend to be paid after 1 year divided by cost of equity minus growth. Or there is another formula which is a retwisted one. Cost of equity is equal to D1, which is the dividend payable at year 1 divided by MPS plus growth rate. Correct? These are the two different formulas. The shuffled one. So the existing growth rate is 15%, students. Okay. The dividend per share is actually how much? Since the question has said that they have been regular in paying dividend, hence 120. So this dividend is already given as 125. So this 125 divided by the number of shares will give us the dividend per share. This is for the company we are talking about, SVL. Okay. So the dividend per share is 125 divided by 12.50, which is 10 per share. So the dividend that we are paying is 10 per share. Earnings we are having 20 per share. Okay. Market price per share is already given as 75. Cost of equity. Now if you see, students, cost of equity we can calculate by this. So the current dividend multiplied by 1 year after growth rate, which is 1.15. You understood this because we have to take D1 value, students, here. Okay. Divided by the current market price plus 15% of growth rate. Clear? So 10 rupees is the dividend as on today. We have to calculate D1. So here D1 is equal to 10 into 1.15, which is 1 year from today. Okay. So this is one. Okay. So the cost of equity comes how much? 0.3033. Okay. Or we can say 30.33%. Now this is basis the existing growth. We have also been given if the growth rate changes to 18%. Expected growth rate after merger is given as 18%, right, students? So in this case, what will happen now? The expected market price per share basis growth rate of 18% will be calculated how? We will take dividend multiplied with the revised growth rate to arrive at revised D1 divided by cost of equity, which is the existing cost of equity minus growth, the revised growth. So this will become 95.70. Clear, students? So here we will take the revised growth and calculate what will be the revised market price per share basis the revised growth, keeping cost of equity similar. So the premium over current price, that is 75, will be 95.70 minus 75. This is the premium divided by 75 into 100. So this is 20.70 divided by 75 into 100, which is equal to 27.60 students. Clear? So 27.60 becomes the premium that they can give. Now we can compare both the options, right? First and second. In the first option, 49.35% is the premium that the company is ready to pay. And using the second option, 27.60% is the premium that the company will be ready to pay. Okay. Now, during the course of negotiation, the third part is asked to us. During the course of negotiation, ICL will push forward valuation based on. Any idea, students, which valuation will be pushed forward? Any idea or any guess? Which valuation will be pushed forward, the lower one or the higher one from ICL side?
Lower one.
Yes, lower one. Because they will say that they will pay lower only, right? On growth rate method, as it will lead to least cash outflow. Clear? Clear, students?
Clear.
Perfect. So this was a very good question in terms of the way this question has been asked is you will have to just rely on the facts that are given in the question. And it is revolving around this principle itself, which we discussed, right? That what is the perceived value that you are generating because of the asset that you have purchased. So the maximum amount that you are ready to pay is up to that level. Okay? Of course, with the different methods. Okay, students, now let's move to question number 6. ABC, a large business house, is planning to sell its wholly owned subsidiary KLM. Now it's a question on selling. Another large business entity, XYZ, has expressed its interest in making a bid for KLM. That means XYZ is going to purchase that. XYZ expects that after acquisition, the annual earnings of KLM will increase by 10%. So they are saying that after acquisition, it will increase by 10%. Following information, ignoring any potential synergic benefits arising out of the possible acquisitions, are available. Profit after tax for KLM for the financial year which has just ended is estimated to be 10 crore. So the previous financial year they have earned 10 crore. KLM's after profit tax has been increasing trend of 7% each year and the same is expected to continue. So 7% it has been increasing. Estimated post-tax market return is 10% and risk-free rate is 4%. The rates are expected to continue. Corporate tax is 30%. Now, number of shares for XYZ and ABC they have given us. And they're saying that the proxy entity for KLM in the same line of business. Proxy means a similar entity. Current share price they have given, dividend payout they have given, debt equity at the market. So they're saying that the entities which are doing business, just like KLM, they are having a debt equity ratio of 1:4. P ratio of 12, equity beta of 1.1. And similarly for XYZ and ABC, they have also given. Assuming gearing level of KLM to be the same as for ABC and a debt beta of 0. So they are saying that for KLM, you assume gearing level as same for ABC and debt beta as 0. Even if the debt beta was not given, we would have assumed it to be 0. You are required to calculate appropriate cost of equity for KLM based on the data available for the proxy entity. So they are saying first you calculate the cost of equity. So students, if you see, okay, let me first explain what is meant by what is the general facts of the question. Okay. So first of all, there is a ABC limit, there is a ABC company. It has a subsidiary, right? Perfect. It has a subsidiary called KLM. There is a subsidiary called KLM. XYZ has taken a bid to purchase this company. Okay. One more thing, students. Beta ungeared is equal to beta of equity multiplied by equity divided by equity plus debt 1 minus tax, right? Proportionate. So beta of proportion to the equity value plus beta of debt proportionate to the debt value. Okay. And this beta is actually called as the geared beta. Okay. And the beta ungeared is called as the where there is no presence of debt. Okay. So these are the two different terminologies. So beta ungeared is equal to 1.1 is the equity value of beta, correct? Multiplied by 1:4 is the debt equity value, this one, right? So multiplied by 4 divided by 4 plus 1, 1 minus tax rate of 30%. The corporate tax rate is 30%, students. Plus 0. Why I am doing 0 is because beta of debt is equal to 0. So the overall, the second part of the equation becomes 0. So the beta ungeared is equal to 0.9362. This is basis the proxy company that we have computed. So students, are we clear till now? Are we clear till now, students?
Clear.
Perfect. So students, now we will have to compute the beta geared for calculating the cost of equity. Beta geared for KLM needs to be ascertained for calculating KLM cost of equity. We'll explain how. So here the cost of equity using the capital asset pricing model. Using capital asset pricing model. How do we calculate the cost of equity here? Risk-free rate of return plus beta of equity. This we need for the geared beta multiplied by market premium, right? Which is the return of market minus risk-free rate of return. Now we'll have to calculation of KLM's geared beta. Now students, if you see, the question has given us, assume the gearing level of KLM to be the same of ABC. So ABC, the gearing level is 1:3, right? So we will have to assign the value of 1:3 to come at the geared beta. So beta ungeared is equal to beta geared multiplied by equity divided by equity plus debt 1 minus tax rate. So 0.9362 is equal to beta of geared is what we will have to compute multiplied by 3. 1:3 is the debt equity, right? So 3 plus 1 minus 30%. So here beta geared will become 0.9362 multiplied by 3 plus 0.70 divided by 3, which is equal to 1.1546. This is the geared value of beta, 1.1546 students. So hence the cost of equity risk-free rate of return of 4% plus geared beta multiplied by the market premium, right? 10% minus 4%. So if you see, the post-tax market return is 10% and risk-free rate is 4%, students. Okay. So this is what we have put in the cost of equity formula. So the cost of equity for KLM is equal to, if we solve for this, it will be 10.93%. So KLM as a subsidiary, so the shareholder who has invested in that will have a cost of equity equivalent to 10.93%. Clear, students? B. A range of values for KLM both before and after any potential synergic benefits to XYZ of the acquisition. So they are saying both bases before and after any potential synergic benefits, you'll have to compute their values. So what we will do, we will have to arrive at the valuation of the business. Okay. So valuation, and of course we are given cost of equity. So we can use basis the earnings model, valuation based on earnings. Using proxy, using XYZ, right? The XYZ means the new company which is going to take over, right? From their perspective. P valuation, okay? Pre-synergistic value. So what is the P ratio? Using proxy. P ratio is 12. Correct? Earnings was how much? 10 crore, right? We just saw it to be 10 crore profit for the KLM. So 10 crore into 12. And XYZ will be 10 crores, the same profit multiplied by XYZ P ratio. XYZ P ratio is how much? 10. Right? So 10 crore into 10, 12 crore into 12, 10. Again 120 crores. From the perspective of proxy and XYZ's perspective, it will be only 100 crores. Because they will say that the business is coming to us. So our P ratio should be applied. While the KLM company will say that, see, my proxy company is having a 12 times P ratio. I should apply 12, right? And now post synergistic value will be 12 as the P ratio, 10 crore as the existing profit into 1.10 as the increase in the profits, because it is mentioned in the opening para that the XYZ expects that after acquisition, the annual earning will increase by 10%. So we are adjusting the annual earnings by 10% here. So it becomes 132 crores. So how have we arrived at it is, this is 10% synergy benefits, right? And here it will be 10 times multiplied by 10 crores into 1.1, which is actually 110 crores. Okay, students. So this was using the P ratio, the most simplest method. Now using the dividend model. So the value using dividend model we just now saw is equal to D1, which is the dividend to be paid after year end, divided by cost of equity minus growth. Right? So the proxy and XYZ, right? Two companies we are talking about. From the proxy's perspective, the pre-synergistic value will be. So what is the cost of equity, students? 10.93, right? The one that we have computed. Growth is how much? 7%. It was mentioned in the question that the 7% it will grow, right? What is their dividend payout ratio using the XYZ proxy? It is 50%. And XYZ, sorry, using the KLM proxy, it is 50% and XYZ it is 40%. So we will adjust for their respective dividends in their dividend ratio. So 10 crores multiplied by 50%. But again, this 10 crore for 50% is as on today. This is D1. D1 we will have to take after the growth of 7%. Any question, anyone? And here, I'm just writing it 10 crores multiplied by 0.40. 40% is the dividend payout ratio multiplied by 1.07 whole divided by 10.93 minus 7%. So this becomes 136.13 crores and this becomes 108.91 crores. I hope this is clear, students. Then we will have post synergistic values. Now in this we will add the synergy of 10%, right? So 10 crores multiplied by 1.10 multiplied by 50% as dividend payout and 1.07 for the growth rate. Correct? Growth rate for calculating it after 1 year. And this divided by the 10.93% minus 7%. So this becomes 149.75 crores. Okay. And here it will be 10 crore multiplied by 1.10. This will remain same. But for XYZ, the dividend payout ratio was 0.40 multiplied by the growth rate of 7%. This will divided by 10.93% minus 7%, students. Right? So this is 119.79 crores. This is what the value comes out to be post synergistic value. Clear? Now, if we just plot it, what is the minimum and what is the maximum amount in both pre-synergistic and post-synergistic? Let's first talk about the pre-synergistic values. So pre-synergistic, we have here, let's first find out the minimum value, okay? So 136 and 108. So 108 is the minimum value from here. And if we go to the PE valuation, 120 and 100. So the minimum, the lowest value is 100 crores in pre-synergistic, right? The maximum value in pre-synergistic is 136 crores, right? Because in PE basis also we have 120 and 100 crores. So it is 136.13 crores. This is pre-synergistic. Now if we talk about the post-synergistic, students, so let's see basis PE ratio, what was the value? Post-synergistic, 132 and 110, right? So these are the two values. And using dividend model, 119 and 149. So the maximum is 149 and the minimum is 110. $149.75 crores. So this is our final evaluation of what the deal price will look like. The pre-synergistic values is how much and the post-synergistic values is how much. Any questions, students, till now? Okay. So we'll move to the next part then. So students, we have covered till question number 6. We'll go to question number 7. But let me just summarize the question number 6 overall. So 1, it has explained us the concept of geared and ungeared beta, first of all, students, right? So what do we mean by ungeared beta? Is given by this equation wherein you take the respective betas of equity and debt, multiplied it with the respective weights to arrive at the ungeared beta. And the geared beta is only that belongs to the for the equity. Okay. Then in this, there was an important connection between the proxy entity for KLM and XYZ. Since XYZ is purchasing the company, XYZ will also be interested to see that if I apply my parameters to KLM, how will the numbers look like? Okay. And similarly for KLM proxy business, definitely the KLM shareholders will want the adjustments to happen basis the proxy business of KLM. Okay. Clear? Now let's move to question number 7, students. Given is the following information. Day and Night Limited, there are two different companies. Net earnings is given 5 crores and 3.5 crores. Number of equity shares is also given as 10 lakhs and 7 lakhs. The shares of Day Limited and Night Limited trade at 20 and 15 times their respective PE ratios. Okay, so 20 times and 15 times is the respective PE ratio for Day and Night Limited. Day Limited considers taking over Night Limited. So Day Limited is taking over Night Limited by paying 55 crores, considering the market price of Night Limited reflects its true value. So 55 crores will be paid to Night Limited, or let's say the shareholders of Night Limited. It is considering both the following options. Takeover is funded entirely in cash, takeover is funded entirely in stock. You are required to calculate the cost of takeover and advise Day Limited on the best alternative. We can probably calculate both the things, right? It's easier. So let's first populate the facts and figures that are given to us. Let's go to solution, students. So two companies, Day Limited and Night Limited, wherein Day Limited is acquiring Night Limited. So the net earnings is how much? 5 crores and 3.5 crores. Number of equity shares, 10 lakh and 7 lakh, right? So their earnings is given, the number of equity shares is 10 lakh and 7 lakh. PE ratio is also given to us 20 and 15 times. 20 times, 15 times. The earnings per share can be calculated, yes. Net earnings divided by the number of equity shares. Five crores divided by 10 lakhs. 3.5 crore divided by 7 lakh. Right? So here it is 50 and here also it is 50. Market price per share. Through EPS and PE ratio can we calculate? Yes. So EPS into PE ratio, students. Right? So this is 50 into 20. So this is 1000. This will be 50 into 15, which is 750. So the market price per share is calculated. Clear, students, till now? I hope all of you are with me. Then market capitalization will be 100 crores, right? Which is 1000 multiplied by number of shares, 10 lakhs. Okay. And here it will be 52.50 crores, which is basically 750 the market price per share multiplied by 7 lakhs number of shares. Okay. Now let's jump to what is being given in the question. Takeover is funded by entirely in cash. Now let's take this. If takeover is funded by cash, what is the cash that they're planning to give, students? They're planning to pay 55 crores of cash. Correct? Who is planning to pay? Day Limited. And what are they getting in return? A market cap of 52.50. Right? So it is just simply like that I am purchasing a land of 1 crore for which the market value is only 80 lakhs. So am I paying 20 lakhs more? The answer is yes. Is it my cost of takeover? The answer is yes. So the cost here means the extra premium that I have paid. Okay, the cost of takeover to Day Limited is equal to 55 crores minus 52.50 crores. Correct? So this comes out to be 2.50 crores. Clear, students? Now the next part is if takeover is funded by stock. Yes, you're right. Sanjay, you're right. If takeover is funded by stock, so the stocks are being issued. That means we are issuing the equity shares. So first of all, we'll have to compute how many equity shares to be computed. So the number of shares to be issued is the 55 crores worth of consideration that we have agreed and the 1000 rupees of the market price per share of Day Limited for which the company is getting issued. Right? So this becomes 5.5 lakhs. So the combined market value will be 100 crores plus 52.50 crore, right? This is the combined market value of day and night put together, 152.50 crores, right? So in this, the proportion of Night Limited's shareholders in the Day Limited's revised capital structure will be, so how many shares belongs to Night Limited shareholder? 5.5 divided by 10 lakhs are the existing shares plus 5.5 they have additionally issued. So this will calculate that what percentage of holding belongs to shareholders of Night Limited in the revised Day Limited. Okay. So that true cost of merger will be in the overall amount of valuation, how much belongs to Knight Limited minus the consideration that we have paid. So this is minus 0.893 crore, students. Now if you see here, since the true cost is negative in case of funding from stock, Day Limited would be better off by funding the takeover by stock. That means they are getting a benefit here by funding through stock. Clear, students? So any queries, any doubts, students, please do let me know. Perfect. So this brings us towards the end of today's session, students. So today we have discussed about the mergers and acquisitions basics, some of the concepts, and we have covered till question number 7. So I request Ashish sir to please help with the concluding remarks.
Thank you, Devas sir. Thanks a lot.
Thank you, sir.
So we have started with one of the very important topic, that is merger, acquisition, and corporate restructuring. So basically, we can say that almost one question come from this topic without any fail. It is one of the very important topics. So, and not only that, this topic is also very important from practical point of view and strategic point of view as well. Because when we say that, of course, earlier the name of this paper was strategic financial management. To some extent, this purpose was this, because merger acquisition is one of the kind of a strategic management decision. Because if this decision goes good, correct, then company, we can say companies growth grows at a very fast speed, and even they sustain for a long time. But if it goes in a wrong side, so then even the companies collapse and even business collapses. So this is one of the very important decision. Now regarding this decision, so far where various aspects are involved, like due diligence, corporate, this is corporate law aspect, that is company law aspect, and SEBI LODR guidelines may also be applicable. There are many other, and even we can say Competition Commission of India's Act as well, as they are also. So there are many other aspects, but here our purpose is basically concerned with the financial management aspect, and that is mainly related to valuation. So this part we have covered in our earlier chapter, that is chapter number 13, business valuation, where with the various aspects of the valuation we have discussed. Now in this part, normally we cover the financing part as well as share swap ratio. This is one of the very important area. So normally the question comes in a how we have to swap the ratio, what is the share swap ratio, and these are normally question answer. Of course, there is one question of internal reconstruction as well. This is, but generally this is covered in your I think financial reporting paper, so you don't face any problem here. So here we have to take care of share swap ratio, and Devas sir has discussed, and one of the very important point is that synergy effect. In merger and acquisition, one of the very important aspect that we have to take care, it is synergy effect. It is because of the synergy effect we say that we have to go by for the merger and acquisition, because it is a win-win situation for both the companies, acquired as well as acquiring. But sometimes what happens, this acquisition, this merger acquisition, or we can say acquisition, is non-friendly. Okay, so in this case, the company which is acquired, it becomes a target company. So when they become the target company, of course, there are some defense mechanism, or we can say defense strategies, where a company can save itself from this unfriendly merger acquisition. So this is also very important from theoretical point of view. So student, please remember, in this chapter, not only the numerical part is important, the theoretical part is equally important. So my request to you, please don't ignore this theoretical part of it. Divas sir has taken up initially, he has started with the theoretical part. Of course, it is one of the part, but if any part has been left, so my request to you, please take it from your refer your study material, and because numerical theoretical question can also be asked from the same. So Divas sir, thank you very much for sparing your precious time and enlightening the student on this topic.
Thank you,
And
sir.
student, thank you very much for your patient listening. Now just we are sharing our telephone number 0120 3045 956. Okay, our email ID is sfm-final@icai.in. Okay, student, thank you very much. I think all your queries have been taken up. And in case still you have a query, you can contact us. Thank you very much. And have a
Thank
nice
you.
day. Thank you.
Thank you very much.
Thank you,
Thank
sir.
you very
Thank
much.
you.
Thank
Thank
you.
you all.
Thank you. Thank you.